IREN experienced one of its sharpest sell-offs in weeks today, closing at $41.12, down $7.37, which represents a decline of more than 15% in a single trading session. What makes this move stand out is not just the size of the decline, but the context in which it occurred. The drop comes after several weeks of volatility, ongoing concerns about financing, and a growing awareness among investors that IREN's rapid expansion into AI cloud infrastructure may come with higher-than-expected dilution risk. The market is clearly reacting to something deeper than just a bad trading day. To understand the full picture, it's important to walk through what happened today, what triggered such a strong negative reaction, and how this fits into the larger story playing out for IREN. Today's sharp decline appears to be driven primarily by renewed attention on warrants and dilution risk tied to recent financing deals. Over the past several weeks, IREN has issued convertible notes, debt instruments, and financing structures that include warrants. These financial instruments all share something in common: they have the potential to increase the company's share count significantly. And when the share count increases, the value of each existing share becomes diluted. Investors hate dilution. Even when it's necessary to fund the company's future, the immediate emotional response is almost always negative. Warrants are essentially a contractual right that allows investors to buy shares at a set price in the future. If the warrants are exercised, new shares are created and issued, which expands the company's total share count. Convertible notes work in a similar way. They start as debt, but they can later be converted into equity, meaning more shares are created. From a corporate finance perspective, these tools are common. Cash-hungry companies use them to raise money without taking out traditional loans or immediately issuing large blocks of shares. But from a market psychology perspective, these tools trigger fear, especially among retail investors who have seen other companies dilute heavily in the past. The intensity of today's drop suggests that the market is not merely reacting to the concept of dilution, but to the probability of it accelerating. Investors may now be asking themselves, if these warrants convert, how many new shares will be issued? How much will that dilute existing shareholders? And will the company need to continue raising money through instruments like these as it builds out its massive AI infrastructure expansion? Because IREN is trying to build high-performance data centers, GPU clusters, cooling systems, and AI cloud infrastructure at hyperscale, it sits in one of the most capital-intensive parts of the technology sector. Building this kind of infrastructure requires enormous upfront investment. Revenue recognition usually lags behind construction, deployment, and scaling efforts. That means the company must spend a lot now to generate revenue later. When a business model looks like that, dilution becomes the path of least resistance. It may not be desirable, but it is often necessary. This is where investor tension emerges. Long-term investors look at IREN and see a company with huge potential. The Microsoft partnership stands out as one of the biggest deals ever achieved by a company of IREN's size. The demand for AI compute is skyrocketing. Hyperscalers are desperate for GPU capacity. Investors know that if IREN successfully builds out the infrastructure needed to support massive AI workloads, the long-term payoff could be enormous. That's the bull case. That's the thesis many investors believed in when the stock rallied earlier this month to more than $76. But the bear case is simple. A company expanding this aggressively may need to raise capital again and again, meaning each round of financing could erode shareholder value. Dilution in small doses is manageable. Dilution in large or repeated doses can destroy share price momentum for long stretches of time. This is why the drop today was so violent. It wasn't simply about today's warrants. It was about the fear that dilution might not be a one-time event but instead a recurring theme. The sell-off also reflects timing. When dilution headlines appear during a period of already heightened volatility, investors are much more sensitive. Over the past several weeks, IREN has faced broad market weakness, AI sector rotation, earnings-related disappointment, and financing-related uncertainty. When a stock has already fallen substantially, negative headlines land harder. That is what made today's 15% decline so dramatic. Investors were already concerned. The new fear only amplified the existing tension. Another layer in today's reaction is that warrants and convertibles create a structural price ceiling. When investors who hold these instruments know they can convert into shares at a set price, they sometimes hedge by selling shares in the open market. This can create downward pressure on the stock, especially when combined with broader pessimism. It doesn't mean the company is failing. It simply means the market mechanics tied to financing instruments put pressure on the stock. This pressure becomes even more pronounced when liquidity thins or when market sentiment is negative. The deeper question now is whether this event fundamentally changes the long-term thesis for IREN. On one hand, the dilution risk is real and should not be ignored. Investors must understand that IREN will almost certainly need more capital to complete its build-out. As the company scales to meet AI cloud demand, capital will be a constant requirement. That means the risk of further dilution is always present. But on the other hand, the long-term opportunity for IREN remains enormous. The demand for AI compute is growing at an exponential rate. The companies that can deliver the infrastructure needed to power this new wave of technology stand to benefit massively. IREN is not building small projects. It is building large-scale, high-performance infrastructure that could position it as a major player in the AI era. For long-term investors who believe in the thesis, days like today are painful but not necessarily thesis-breaking. Dilution is part of the story. Growth comes with cost. And the companies that front-load their investments often reap the largest rewards later. But for short-term traders, the drop today may signal more volatility ahead. The reaction shows just how sensitive the market is to financing risk. And until the company clarifies its capital strategy, every new headline could trigger more volatility. Moving forward, there are several key things investors will want to watch closely. First, clarity around the total number of warrants outstanding and the exercise price for those warrants. This will help investors understand the potential magnitude of dilution. Second, updates on the convertible notes, how much debt could convert into shares, and at what price. Third, the company's broader capital strategy. Will there be more raises, and how soon? And fourth, progress on the revenue side. If IREN begins generating significant revenue from its AI infrastructure deals, especially with Microsoft, the dilution becomes less concerning. A strong revenue profile can offset dilution and restore confidence. In the coming days, the stock may remain volatile as traders digest today's move. Some will see this as a buying opportunity, especially if they believe the long-term AI infrastructure story outweighs the short-term dilution concerns. Others will wait for clarity, and others may exit, unwilling to take on the additional risk. What happened today is a reminder that high-growth companies often face moments of extreme volatility. When they seek capital, the market reacts. When they take on ambitious projects, the market demands results. And when expectations are high, every new filing or financing event carries weight. IREN is no longer a small, speculative mining company. It is positioning itself as a major player in AI infrastructure. That comes with opportunity, but it also comes with financial strain and the need for constant investment. The key is execution. If IREN executes well, scales effectively, meets the demands of its partners, and begins generating significant AI-driven revenue, dilution will be an afterthought. If it struggles, delays, or signals even more financing soon, the pressure could continue. Today's drop was dramatic, but it is only one chapter in a much larger story. For now, the market is reacting to dilution fear. But the long-term narrative will ultimately be shaped by the company's ability to deliver on its AI infrastructure promise.